Welcome to today's class in the series Consolidated Financial Statements. Today, I want us to look at group structure. We're going to look at the direct and indirect holding for consolidated financial statements. So let's begin with direct holding. If you've been following the series, by now you should know what we mean by consolidated financial statements. We say the financial statements of the parent company and the subsidiary presented as one single entity. We say you consolidate when there is control. And we say control means three things, PEA. We say when you have power over the investee, when you are exposed to variable returns of the investee, and when you have the ability to affect those returns, then we say you have control. We also went ahead to define what the parent company is and what the subsidiary is. Today, we're going to look at how you can become a parent. That is a kind of holding. We have the direct ownership and we have the indirect. So you can directly become a parent company and you can indirectly become a parent company. So we're going to begin with direct ownership. So we say direct ownership or holding. Direct holding. Good. Now, how does direct holding occur? When a company directly owns the shares of another company and it is above 50%, we say you have control and we say you have direct holding. So if a company acquires, let's say company A acquires 80% of B, then this is directly, so we have A acquires B. So A acquires 80% of B, then that is done directly. So the ownership is direct. In this case, we say there is a direct ownership. It is assumed that when you acquire 80% of B, you have power over the investee. It is also assumed that you are exposed to variable returns, dividends. The higher the risk, the higher the returns. And also, you have the ability to affect those returns. You can make policies. You can decide that dividends should be paid every year. Even if it was formally not the policy of the company, you can change the policy. So you have the ability to make decisions and to affect the returns that you get. For indirect holding, we have a situation where a company does not own the controlling shares of the subsidiary directly. Rather, it does so through another company. So if you have company A holds 80% of company B, and company B has 51% of company C, then you see that A is indirectly, A is controlling B and B is controlling C. So A does not even have any percentage of holding directly in C, but because A controls B, A is able to indirectly control C because A can use the power over the investee, which is B, to control C. So this is what we call indirect holding. Good. In indirect ownership, in indirect control, there is something we call effective ownership, and examiners love to test effective ownership a lot. So I want us to explain what effective ownership means. Now, if we say A controls 80% of B and B has 60% of C. Look at this. So, you see this? A controls 80% of B and B controls 80%. So we can say C is actually a subsidiary of A and C is actually a subsidiary of B. So B controls C directly. We say when you control another company, you become a parent. And that company that is being controlled is a subsidiary. So if you look at A is a parent company to B. And B is also a parent company to C. But the funny thing is that indirectly, B has a direct relationship with C because B directly owns a high percentage of C. So B directly owns C to the tune of 60%. So there is control. But A does not control C directly, but rather it does so through a subsidiary called B. So it indirectly controls C. This is because A can do everything it wants to exercise power to affect variable returns and is exposed to variable returns of C through B. So it can exercise that power through B. So if you want to calculate effective ownership, what you need to do here, if you want to know the effective ownership of A, the effective ownership that A has in C, then you say this is 80% multiplied by 60%. So this will give us what? This will be 0.8 multiplied by 0.6. And that will give us 48%, which is equal to 0.48, which is equal to 48%. Now, if you look at percentage, you may think that 48% is less than 50, and so there's no control. But there is control. There is evident control, and this control is what we call effective ownership, because A directly controls B and B directly controls C. So A is able to indirectly control C. But the effective ownership it has is 48%. And so you have to consolidate. Good. So to summarize this, there's some common mistakes that students make. So when there's direct and indirect combined ownership, sometimes the parent owns shares directly and also indirectly. Sometimes we have a situation where, apart from A controlling C, indirectly, A could also have some percentage of investment in C. Now, what if we say A also has 20% of investment in C directly? So in this case, you have to get the effective ownership of 48% and add it to 20% that it directly has. So that will give us 68. So everything will be 68%. So this is the effective ownership of A in C. So the first one, you calculate the indirect relationship to get the effective ownership it has. And then you also go ahead to look at the one that it has directly. So if you have enjoyed this class, I urge you to like, to share, and to subscribe to the Finance Simplifier. And don't forget to support the Finance Simplifier. The link is in the description. Our seller.com link is there, so you can feel free to support this channel so we can make more wonderful videos like this for you. The next class, we're going to step it up a little. So this promises to be very interesting, and I urge you to continue to follow the series so that you don't miss out. So we're trying to make you have a rock-solid knowledge from zero to professional. My name is Echela Okori, the Finance Simplifier. Bye for now.